One of the strategies we've implemented to take advantage of where we see the current opportunities in the commercial real estate space is the receivership business. Receivers are the appointed referee by the court between the borrower and the lender, and they really allow us to, one, understand the market intelligence of a specific asset in a specific market, and it's also fee generating income. It also leads to property management, leasing, and sales opportunities that we can collaborate with other firms on in that particular marketplace. So receivership business is an interesting business that we purchased a company in the last 6 months, both in the West Coast and in the Southeast, and it's allowing us first look at a lot of real estate, because we hear a lot about loans coming due, maturities not being extended, borrowers having to come up with equity. So we think the receivership business is one of the growth areas in the commercial real estate space, and it gives us just a lot of intelligence in a very short period of time on an asset class that we may be wanting to put into one of our funds, whether it be a value-add office or grocery-anchored neighborhood shopping center.
Businesses.
Certainly there's a lot of challenges remaining in the marketplace as it relates to commercial real estate, whether it's the amount of debt coming due, and it's about $150 billion for the next 3 years. So it's a manageable amount of debt coming due. There'll be some borrowers and lenders who will go through the foreclosure process. There'll be some short sales, but in general, it's not a tsunami of debt coming due. But it is going to be, it will influence how those loan maturities are handled by the borrowers and lenders. It will influence the psychology of new lenders coming into the marketplace. And it's important that borrowers always be completely forthright and honest with their lenders and their investors, so that there's full disclosure, and that always helps go through the process no matter what the end result's going to be. So debt coming due is certainly a concern. Legacy issues, there's a number of investment funds, and the papers are full of pension funds that got in over their heads as far as an allocation of real estate and the significant write-downs that they're experiencing. So that certainly has a psychological impact on investors, whether it's the beneficiaries of those pension plans. Morgan Stanley just announced there may be a $5 billion write-down in their funds. So legacy issues, whether it's publicly traded REITs, whether it's publicly registered non-traded REITs, whether it's pension funds, those legacy assets and how those losses or challenges are met and communicated to the investor and to the public are really key. At Thompson National Properties, we're pursuing a couple of strategies, both focused on the investor. We have two types of investors. We have a very conservative group of investors who are either coming out of a 1031 exchange and want to just preserve capital, or the income-oriented baby boomer who's now segueing into semi or to complete retirement, is very income and very risk adverse. And so we have a publicly registered REIT that's raising $1 billion and is buying very core grocery anchored or drug anchored multi-tenant necessity neighborhood shopping centers in the western United States. So that's for our very risk adverse clients. Then conversely, we have a number of professional athletes, entrepreneurs, high net worth credit investors who perhaps have not participated in the real estate market in the past and recognize that there is significant value that can be created over the next 3 to 5 years as we enter the near or at the bottom of the commercial real estate market. So we have opportunistic funds who are opportunistic investors who are attracted to value add funds, and we buy properties that are broken, need to roll up your sleeves management,